Good afternoon. Rich Nass with Open Systems Media here for my weekly chat with Ray Zinn. Hello, Ray. How are you?
Oh, doing better. My back's feeling a little better.
Good. I'm glad to hear it. Well, a week's time, should be very helpful for that. Last week we discussed the stock market and the fact that it's going up and how would that affect our industry. So along those same lines, let's talk about Ray's predictions for the future. Let's say 5 years. Tell me what you think is going to happen with our space over the next 5 years. And the last few months have actually been interesting, and I don't know if that's telling. I don't know if it's just a blip or what, but there's been a lot of consolidation over the last few months. Do you think that will continue, and like 5 years from now we'll just have a few big guys and a few small guys and that's it, or do you think it'll look similar to how it is now? What do you think? Well,
consolidation is still a heated battle, and more and more companies are being acquired, especially the smaller companies. And the reason for that, of course, is money is still cheap. And so once interest rates start increasing, then you might see some slowdown in the consolidation. But looking forward, the industry is over 50 years old, and it's getting quite ubiquitous. And by that I mean that it's worldwide, and it just depends upon what the Trump administration does regarding the pressure to keep the U.S. technology within the U.S. and also his effort to increase manufacturing back in the United States. So that'll also somewhat impact what's going to happen to the industry over the next 5 years. I think the market believes or agrees that the industry is going to do much better. We do know, for example, that there is a correlation between U.S. GDP and our industry, so that once the GDP gets above 4%, the industry grows at a multiple of GDP, whereas if below 4%, the industry actually just tracks GDP. And so for the past 8 or 9 years, our industry has actually slowed because the GDP has slowed. But once you get above 4% U.S. GDP, then the industry will grow at a multiple of that, 1.5, and then to 2, and then to 3. And once you get above 10%, the industry will actually grow at 3 times GDP. So that's really good for the industry. Now, what that will do, of course, is that will prompt possibly more VC money being used for our industry, and it'll spur a lot of these startups to get going again, especially with the pressure for more companies to be a U.S.-based company. And I think that actually will encourage investment and encourage these startups, which I think will be good for the industry.
Okay, so what about the guys at the other end, like the Googles, the Apples, the Microsofts? Do you think they'll still be these market leaders, or have they seen their big boom times?
Well, it again depends upon how the GDP goes. I mean, if the GDP does grow at the rate that the predictions are, I mean, from the Trump administration, they're predicting GDP is north of 4%. Then I still think these companies will do well over the next 5 years, and I think that's been the hallmark of what the Trump administration has been promoting is hey, make America great again, and to that end you'll see good growth in these companies, which will help out the rest of the world too, not just the U.S.
Okay. And then finally, what about the role that Silicon Valley as a geography will be playing, say, 5 years from now? I mean, right now it's pretty dominant. If you're a startup, it seems like most of the startups are coming out of Silicon Valley. Most of the innovation in our space is coming out of Silicon Valley. Do you expect that to be the case 5 years from now?
I think so. With the improvement in the economy, then you will get, I think, a renewed vision of technology in Silicon Valley, and even though it's California-based, as you would, and that's not necessarily where Trump wants to focus his efforts on. I still think Silicon Valley, with its very capable talent pool we have here in Silicon Valley, that I do believe that Silicon Valley will still maintain its dominance in our industry.
Are the real estate prices out there making that harder and harder for people to do? I mean, for a startup, for a young entrepreneur, you can't just move there because you can't afford to live there.
That's true, but these incubator opportunities for these startups are also improving and growing, and that's allowing these guys to actually start these companies with the relatively low cost of capital. So I think that the real estate market won't really hurt these startups. It might hurt to some degree employees, but with the talent pool we have, I think salaries will increase. So we do know that the expectations, the predictions are for wages to increase north of 3% in 2017, maybe going up to even 4%. So there'll be a lot of pressure on these companies to pay more money for their employees, and that, of course, will allow them to then afford these more expensive homes.
Sounds good to me.
Well, let me give you another comparison. So,
sure.
In Montana, where I have my ranch, the average salary for kind of the middle of the road, low white collar, high blue collar worker is in the area of $18 to $14 an hour. In California, that is between $14 and $20 an hour. So you can see that there's about a $6 differential per hour between Montana and California. I only do that because I did a comparison recently between the salaries that I pay some of my workers at the ranch compared to what the people would be earning here. So California does still have about a 50% salary advantage over say these rural states like Montana.
Advantage or disadvantage?
Good point. It depends upon how much the housing goes up. If the cost of housing here is about double what it is in Montana, and maybe even more than double. So it is more difficult, with nearly half your salary going to buying a home. It makes it more difficult to live in Silicon Valley, but that's kind of the name of the beast. Salaries will continue to go up. I'm possibly from $14 to $20 an hour, maybe more up to like $16 to $22, $23 an hour.
I guess it depends if you're the payer or the payee, if you're at advantage or disadvantage.
Yep, that's true.
Very good. Okay. Well, I think that's a wrap for today. Thank you, Ray, as always, for joining us, and I'll speak to you next week. Well,
thanks, Rich. Always enjoyable to be with you on this podcast.
Great. Take care.
Thank you.